The idea for my part of the presentation actually comes from a discussion, a good discussion that we had with a long-term client who had noted that we have had better than market returns over the years and with less risk, but was asking whether or not we shouldn't have had more return or less risk. And I think it's a good and legitimate question, and that's some of the aspect of my presentation today, which is to go over the elements of return in our portfolio, but even more importantly, to discuss with you how we look at risk and volatility, because it's a little bit different than the way that the market does. If we look at the last 39 years of our history, the firm has generated better returns, but even more importantly, more consistent, more predictable returns than the marketplace has in general. If we look at those first 39 years, note a couple of things in the chart that we're showing. The first is that the Century Management returns are very much concentrated around those middle of the chart, as you can see, a 10 to 15% return. Those returns have happened about 28% of the time. Secondly, if you look closely at the chart, you'll also notice that over 70% of the time, the returns from the Century Management portfolio have been 10% or more. And finally, if you look at the downside of the chart, those years where there were losses, there were only 4 so far in the last 40 years, almost 40 years, or 10% of the time, and only one time was that loss more than 10%. Now, if we compare the outcomes of the Century Management portfolio to the S&P, we find something very different. Unlike the returns of the Century Management portfolio that are concentrated around the middle part of the graph, that 10 to 15%, the market returns have been aggregated along the edges. You can see that about 18% of the time you could get fairly big returns from the market, 30% plus. But also 18% of the time you could get losses. So the amount of time that the market spends in the loss category versus Century Management is about twice as long. If we look even closer at the loss side of the ledger of the S&P's returns, you'll notice that those losses are actually concentrated on the greater end of the returns. Over 8% of the time, the losses in the market portfolio, exceed 10%. That's 1 out of every 12 years. And another 8% of the time, the losses in the market are somewhere between -5 and -10%. If I line the two portfolios together, so we're looking at both Century Management and the S&P 500, it becomes very obvious that the Century Management portfolio has less erratic outcomes, more predictable returns, and less frequent losses than the market does. And that's despite the fact that our portfolios have had, as you know, a good smattering of small cap and mid cap stocks. So the question becomes, how can that happen? Our answer is, it lies in our investment philosophy, the value philosophy. We truly evaluate stocks as discrete businesses, and we will only buy those businesses when we think that we have a good enough deal to protect to the downside, no matter what adverse outcome there might be. It's our experience that the intrinsic value of the business doesn't change very much, although the price of the stock changes a lot. We call that process identifying value gaps, and all of you who were here last year heard Jim give quite a discussion on what that value gap is and what that means to us. For those of you who weren't here last year or would like to review that, it's on our website, and please review it at your leisure. So you can buy the 500 companies of the S&P, but you have to take the prices that Mr. Market gives you. Sometimes he'll give you companies that are overvalued, and sometimes he'll give you companies that are undervalued. But none of these are handpicked because they offer the margin of safety that we find necessary to protect from the permanent loss of capital. That's our definition of risk, avoiding the permanent loss of capital. That's the hallmark of true absolute value investing. And paradoxically, by sticking to that discipline, not only will you preserve that loss of capital, but over a reasonable period of time, you should also have a pretty handy outperformance. Now, fundamental to knowing how to avoid that permanent loss of capital is being able to distinguish between the difference between risk and volatility. Most institutional investors and most advisors to high net worth individuals like yourself describe risk as how much does the return swing around the average. And as we saw in the S&P 500 chart that was up, that S&P 500 swings pretty wildly, about 36% of the time.